Hey everyone, this week on Around the Coin we have Dan Rosen on the show. Dan is a longtime investor and founding partner in Commerce VC. Commerce VC is a venture fund with a focus on payment technology companies. We talked to Dan today about a lot of different topics ranging from Apple Pay to Bitcoin to on-demand economy. Really a fantastic show and hope you enjoy. Awesome. All right, today is an exciting episode. We have Dan Rosen on the show. He is the founder, creative partner in Commerce VC with a focus on investing in payment startups. Dan, welcome to the show.
Thanks.
Yeah,
welcome, Dan.
Brian and I, Faisal's out today, but Brian and I are very excited to have you on. Dan and I first met in San Francisco a few years ago when I was working on FlowTab, and Dan, I was just impressed with your willingness to sit and listen to us. At the time, we had practically nothing, and I think you just gave us a lot of inspiration, if nothing else, to just keep trucking away and working on it. So as the years go on, I could see you made a lot of great picks and really interesting companies. How did you start Commerce VC, or what came before this? What kind of led you to this tale?
Yeah, no. So first of all, thanks for having me on the show. It's great to participate, and it's been fun getting to know you over the years. I wish there's been a little bit of a hiatus between this and the last time we've chatted. So I'm glad we're reconnecting. So the backstory for me is I've been in venture for about 15 years, and I think that's all I'm really qualified to do. I started Commerce Ventures about 2 years ago, but before that, I was at a firm called Highland Capital, which is I think where I was when we first met. And at Highland, I sort of started off my time back in 2006, right out of grad school, hired in to focus on investments in the mobile space. And back in 2006, and I'm not sure how much you guys remember, the mobile space really was, it was sort of pre-mobile data. I mean, mobile data back then was SMS and some pretty crappy mobile web. So back then I was really focused on infrastructure. So I started by making investments in towers and spectrum and semiconductor companies and equipment companies. And candidly, we did very well in those spaces. But in 2007, and we were looking at mobile applications and across a bunch of different areas like mobile couponing and loyalty and even mobile banking. And I spent time way back then with, the Claremails and Firethorns and this
ancient history now.
Foundry. And there were some successes out of that era of companies, but it was too early for the sort of mobile payment stuff back then because it's still relatively early now. So we didn't make any investments in mobile payments, but it got me to take a really deep dive in the payment space, to understand the trends and exciting opportunities there. And that was called late 06 to early 2007. And back then there really, other than a couple of VCs like Matt Harris, there just weren't early stage investors who were making investments, in the payments and fintech space in any meaningful way. So I started to build a payments and fintech practice at Highland. It was sort of my minor, if you will, back then. And over the years, I spent an increasing amount of time there. I was in the Boston office for 4.5 years, moved to the West Coast, kind of in late 2010. And I, inevitably caught the entrepreneur bug out here in San Francisco pretty quickly, and decided I kind of wanted to focus more on this payments and fintech opportunity than I was able to dedicate just as a generalist at Highland. So I ended up leaving to start Commerce Ventures around, a pretty specific thesis that payments are fundamentally important at the core of kind of commerce and retail transactions, but that there's also a lot of value added around the payment, both for brands and for retailers, but also for fintech players. And so our focus as a firm is really to invest in companies that are enabling those transactions to happen, and value to be added around them. And our investors, what's a little bit unique about us is, we're a non-lead VC investor, although we typically do invest at relatively early stages, seed, Series A, sometimes a little bit later. But we're a non-lead investor because we're a relatively small, neighborhood of $20 million first-time fund. But all of our investors are strategic. So it includes, 3 large corporates, all from the fintech space, and about 36 strategic individuals, including former president of PayPal, the former CEO and founder of CheckFree, the former CEO of CyberSource, the former CEO of Lidl & Co., Anil Agarwal from Money 2020 and TXVia. So we've been very fortunate to get to work with some of the what we perceive to be some of the most interesting and knowledgeable folks in the payments and commerce ecosystem. So anyway, that's a little bit of background. And yeah.
Now, Dan, you talk about the constellation of companies around fintech and payments. How far do you reach out? I mean, retail tech, in my view, retail tech and payment tech are really one and the same. They've been separated, obviously, but ultimately, they converge because the data is so meaningful on the payment side and the retail side with the convergences that are taking place.
Yeah, it's a great question. I mean, the way when I went out to pitch the fund one concept to people, I went through a lot of slides that kind of almost walked through a logical step by step, look at the sort of digital funnel to physical retail. Today we've made many investments across both, kind of technology enablers in digital retail as well as in physical retail. But one of the core early themes for us was really this online to offline, kind of theme, which is, how do you embrace sort of digital demand generation or marketing, and attribute, kind of that marketing to physical, commerce, that occurs thereafter, which is one of these, kind of really challenging things to do. But if you look at, sort of the retail, the percentage of retail spend online versus offline, it's, still obviously dominated by offline spend. So that was a core theme for us, was really this online to offline theme, and and how do you create kind of an attribution infrastructure for digital marketing that kind of is tied to transactions that occur. So for obvious reasons, payments is pretty important to that, but also is mobile and a lot of other types of technologies, including in-store technologies.
So fundamentally, do you view payments as really just a form of digital information as retail data is, or do you see it as even deeper than that?
Yeah, I mean, look, I think the short answer to your question is yes. The addendum to that is, of course, that payments and banking and in general, and financial services in general are regulated industries. So there's a whole bunch of reasons why even though it's at the core intellectually it's pretty easy to think about a payment as information flow, and I think that's where cryptocurrency sort of started. You have to then recognize and accept that regulators kind of have a pretty substantial say as to what payments can and can't do, or how they can and can't occur, which sort of change, which makes it not so easy to just kind of relegate it to kind of information flow, but it also obviously has to comply with a bunch of sort of regulations and restrictions. But I'm sure this is probably overplayed at this point, but I was, sitting at an emerging payments event, I think that was last week, with Bill Reddy. And I think what we talked about, which I think has been mentioned many times, is if you think about the best payment experiences, it's really the ones that you don't experience. So it's, if you, as a consumer anyway, if you think about it that way, there is this sort of recognition that, most people don't really seek out the experience of making a payment. It's something that if it occurs, in a really successful way, you might never really think about the fact that it happened.
I agree. But there is a counterpoint to that, and you can see it empirically in observing many traditional retail transactions. If you, I'm a bit of a research nerd. I spend a lot of time researching people just doing transactions behavior, how merchants interact with it, time and motion studies. And I find that, just standing in, with permission at a Target and watching, people check out on a Saturday afternoon, there is a sort of duet, a dance that takes place in these retail transactions. And some people actually find satisfaction in what they're doing. And I'm talking on both sides of the transaction. Something is being given, something is being taken away, and there's a conclusion of a sale. And I think in all of the startups I've worked with and have observed, a lot of times we as technologists, we overshoot the experience and we say, well, let's just make it so you walk out the front door and nothing happens.
Ryan, are you still there?
And
looks like we had a little break in the connection, but I think we're both here.
It's such a cliffhanger. I'm actually so curious how he's going to finish his sentence.
Let me see if I can.
Oh, Brian, there we go.
We had a little break, but go ahead. We don't want to ruin your flow.
You said sometimes as technologists we overshoot, and then that was it.
Yeah. So sometimes we overshoot the experience, right? I don't know if we got the thing about Target, but basically when you research and look at how retail interactions take place, there is actually a bit of enjoyment that people get out of a retail experience. If the line is bad and the wait time is too long and you had to walk too far to get your stuff, yeah. But, if you go into a Target or you go into especially a membership store like Costco, you actually see people invigorated by the shopping experience, invigorated by the fact they have to climb up and get their product and bulk it together and put it in their own bags and hand over their check card or their credit card or their Apple Pay and get that interactive experience. And what I've noticed over the years in watching new wallet developments is that when we're not mindful of the time and motion study research of how people really interact, there's this experience that a lot of people feel is missing. It's like, did I really complete that transaction? When you start stepping up consumers, have you experienced that with some of the startups that you're viewing and some of the ideas that they're coming up with?
It's a great question. I mean, we have not invested in a company that had a competitive, sort of entry into mobile payments. And I think I would be honest that, most of that is because I think we perceive that, that mobile payments at the very heart of that interaction at the point of sale was really a game to be won by large players. That's, I think that's been our perception. And I think that's playing out. But the other piece of it is I actually think you're probably right. There's a set of kind of activities and experiences around the checkout that works really, really well today. The line, we could talk about the lines and, certain categories of retail where people don't like waiting in lines. I think in general, people don't like waiting in lines. It's potentially, but I see your point. I mean, there's sort of an ego expression and a social interaction that occurs at the point of sale. So people seeing you buy something, that can be satisfying, at least from an ego expressiveness perspective, and then obviously social interaction with the clerk, depending upon kind of the environment, I think can also be satisfying. We haven't really focused on kind of trying to disrupt that in any way. I will say we're investors in a company called Boomtown, which supports a whole bunch of merchant technology, and so clearly this tablet point of sale trend kind of touches on kind of that area, and I think in large part it's attempting to make the checkout experience better. But not trying to completely remove it. The one area, I guess, and this is a question back to you. I mean, what do you think of Reserve? Where I think there's, certainly that's one type of a retail transaction where the payment is completely removed, no card tendered, just kind of here's the bill that you already paid.
Well, it's really within the business model. Like an Uber experience is incredible, but I don't think you can Uberize a vast majority of retail type transactions as much as we'd like. And I think it has to do just the way we are social animals. I think, what Mike had experienced with FlowTab, the whole bar experience, that's a theatrical experience. You go out to a bar, even if you're trying to just have a drink, whatever, it is a bit of a theatrical experience. And some of it is waiting in that line at the bar, right? It's the getting behind a few people and meeting and chance occurrences. I think Mike can speak to that, right? You discovered with FlowTab that some people just wanted to wait, right?
Yeah, I mean, I think, Brian, you said it perfectly when you described the experience that consumers have at retail locations. And there's sort of the appeared friction or appeared frustration in the experience, but it's actually part of the enjoyment. I mean, the same thing goes for hospitality, the industry. And I think there is a gradual process away from that friction, right? Like if you rewind the clock and you look at, do people really enjoy going to the post office and mailing letters? Yeah, they sure do. It takes them 30 minutes. They see everyone in their town. They get to talk to everyone. So if you were sitting back then and you're saying, would email ever take off? People are never going to want to leave, going to the post office. And I think you look at it and you see the benefits of the experience. Like people enjoy the checkout line, or they enjoy the bar, or they enjoy whatever they're doing. But at the end of the day, if you make it better, they'll find somewhere else to find that enjoyment, right? They'll go dancing, or they'll go to a coffee shop, or they'll do something else that's not absolutely required. I think people just naturally make the best out of experiences, but I wouldn't limit yourself to say that we're going to be stuck in a world where you're not going to be allowed to check out mobily because people love, like,
I agree.
You know what I mean? So,
I think the astute merchants and the astute startups will look at transforming that experience. All right, if there is going to be a line, what are people normally doing in that line? And really good retailers, obviously, if you look at the checkout area of a good retail store, you know exactly what they're thinking. That's all scientifically derived. Exactly every pegboard item is put there for an exact reason. And they are making, in some cases in pharmacies, sometimes 45 to 50% of their profits within 12 feet of the checkout station. So that whole thought process taken to the startups, I think, is a dynamic, possibility. And I think all these convergences is part of my thesis that, you have payments, you have the data and all that.
We see that 100%. We see that. I mean, so we're investors in a company called Retail Next. It's one of our largest and most successful portfolio companies. And I mean, they analyze, kind of visually and also using, Wi-Fi and beacons and other types of sensors, digitally, kind of what happens inside of a store. And, they can find optimization opportunities that can increase same store sales 10, 15, as much as 30%, which is huge. But the truth is, it's not. It's never about getting rid of the line. It's not. I mean, it's they're these stores are pretty well optimized. They're not doubling sales. They're not. I mean, it's these that those numbers I quoted are sort of that's kind of probably the best you can do, and it's usually because structurally kind of there's an aisle isn't exactly optimized or display isn't in the right place But yeah, no, I'd say it's a really exciting area of retail.
That's an interesting thing. If you can speak to this, how's the message translating to merchants when they come out and talk about this new technology? Because it's really relatively new for most merchants. How do they see it? I mean, the merchants are they first sort of like, what are you talking about? Or are they really kind of getting it pretty quickly?
Which technology do you mean specifically? Do you mean analytics or?
Well, the whole Retail Next experience.
Sure. Talk about. So, I mean, it's actually relatively straightforward in a lot of cases because many retailers have for many years had some method. They've had some in-store analytic technology that most of us don't really think about, which is, at the very least, loss prevention related technology. And then, typically, there's been video infrastructure in a lot of stores, for the purposes of security and just monitoring. And then, in addition to that, there's been traffic counting with folks like ShopperTrack in a very, kind of legacy way for many, many years. So a lot of this infrastructure has existed over the years. It's just been, kind of disconnected. It's been, on systems that don't, kind of that don't scale, that don't kind of talk to each other, and are very hard to build applications on top of. So what Retail Next did was basically created a analytics platform that can bring data that's captured from a variety of different input sources. They started with video, and added a bunch of other ones. And so what they always do when they talk to a retailer is focus on a specific lead application, whether that's traffic counting, loss prevention, kind of employee, kind of optimization around shift, kind of management, or, kind of something much more, kind of advanced, like, analyzing the full path of shoppers' movements through stores, how much time they spend in front of certain displays and the effectiveness of those displays, kind of demography and ethnography. There's a variety of different, kind of more advanced applications you can get from that infrastructure. But typically you start with something relatively basic. So it's not quite so, kind of, it's not quite so foreign to them, but it's still a pretty considered purchase, for sure.
So, in looking over the Karen portfolio companies, I just imagine so many of them being connected. I mean, just while you were speaking, looking at how Owner Listens and Retail Next and things like that sort of interconnect with a sort of theme. It just seems like you have this sort of mantra that you're following, and it's quite amazing. I don't think any other VC firm is doing anything quite to this level. Do you work hard at this theme?
Yeah, I mean, look, what we've tried to do is be thematic and go segment by segment in kind of across the themes that we care the most about. I'd be lying if I told you that there weren't opportunistic investments that we've made, just because somebody that we've known and really respected for a long time was creating a company and raising some money, and we felt lucky to be involved. But yeah, I think the majority of our investments really do follow that thematic focus. And it's in a lot of ways, it kind of, if you think about retail, on the retail side, it kind of goes from the top of the funnel down through to kind of the transaction and the kind of loyalty thereafter. On the fintech side, it's also kind of thematic, but it's the connectivity between the different companies is sort of feels different, because you're investing in different parts of the financial services ecosystem that don't necessarily have to work with each other, from a startup perspective.
Dan, I'm curious on your side of things. From the founder's side, I feel that there's often an influence in the investor's mind of what industry or sector is hot, and just kind of the continual focus from investors on startups in the space. Mm-hmm. And you must feel the same effect happening on your side, where you'll feel either the Bitcoin or some particular segment of Bitcoin, or whether it's fraud detection or mobile wallets, like they have such volatile sort of demand curves, where
Yes.
Investors are really, really interested in one particular segment, and it must bait you a lot to go and try to make investments in the space while it's hot. But at the same time, I'm sure you realize that it's a psychological effect, and that there may not be larger returns where everyone runs, almost like the chasing after gold mentality. How do you recognize when that happens, and recognize that and not fall into a trap of investing in a company just because everyone thinks it's a hot deal?
Yeah, look, this is a great question. I think a lot about, and I'm actually in the process of putting together a presentation for a very large strategic focused on this. The way I think about it is, I mean, having been a venture, through 2 or 3 different cycles, you've sort of seen. I've seen kind of markets fluctuate pretty substantially. So the first piece is just understanding the flows of capital to innovation, and that's dominated obviously by venture capital money and obviously to some extent angel investment. When you look at venture investment and angel investment, what's happened in the last few years is really, I mean, back in 2009, when we kind of hit the skids, the economy hit the skids, the public markets fell apart pretty dramatically. Valuations came way down in the public markets, but private markets didn't come down nearly as fast, because they lag and just in the way that those valuations are marked to market. So, there's this, kind of way over allocation of institutional investors' portfolios to private investments. So basically, the spigot turned off, pretty rapidly and completely for new commitments to venture and to private equity. But venture probably felt it the worst. And so what happened is, for the next few years, venture was way underfunded relative to, kind of, where it had been historically. And so, but as the public markets came back, there was a very substantial recovery in the public part of the portfolios. And so in the last kind of 2, 3, 4 years, institutional investors are looking at their allocations and realizing they're way under allocated for venture and alternative assets that can outperform the market. So the sort of the pendulum has swung back, and we've seen unprecedented flows of capital back into venture. So there's been a ton of fund formation. When you mix that in with sort of the institutionalization of the seed, kind of investment process, where we have institutional seed funds, what's happened is there's been a proliferation of innovation in general, and because of cloud architectures, it's just a lot cheaper to start companies now. So I guess that's a long way of saying I think the environment has gotten kind of there's way more kind of raw material for innovation and resources for innovation than there has been in a long time, and so that as the market has kind of improved, there's been a lot of money flowing into what I would perceive as high value kind of areas where if there's a disruption, the winner can create a very, very big business. And cryptocurrency is a perfect example of this. I think most people would recognize that kind of certainly in the near term, creating a really, really big business in the cryptocurrency space has long odds. But if it happens, the business, if cryptocurrency disrupts money in a meaningful way, the outcome is so large that you can't afford to ignore it, and it's fundamental to the financial services ecosystem. And so I think there was a few categories that look like that, right? Alternative lending or platform lending, depending on how you think about it. Certainly, cryptocurrency and then payment acceptance to a certain extent. Although I would argue that payment acceptance is a little bit less disruptive. Even though there have been disruptor players. In that space, retirement planning is seeing this, with the robo-advisor, kind of entrance. So I think those are the categories where I could argue that they've become very, very hot. Although cryptocurrency has probably fallen off a little bit lately. So to your question, we track all of these hot categories and segments, very closely, and over the years, and I've been looking at these spaces for a long time. I've ended up meeting with many of the companies that are now, the hottest companies in these spaces. Just by following the space and tracking, kind of activity. I think the challenge for any investor, but specifically the way we think about it is, we started our fund 2 years ago, as a benefactor, but also a victim of the timing of that. We have to be very mindful of the valuations at which we invest, and kind of even if there's a nice return opportunity, if an investment profile doesn't fit the strategy that we promise to our investors, it's kind of it kind of isn't the right investment for us to make. So both. I'd say cryptocurrency, it has been a space that I continue to have some questions about timing. But, in terms of alternative and platform lending, that's a very interesting space that, candidly was pretty well funded even when we were just getting started. And so, the idea of investing at pretty high prices, as a small part of a $50 million round, let's say, just, kind of didn't fit with the investment strategy that we've had. So there's a mixture of things that occur, which is, sort of this practical, commitment to a strategy you promise your investors, which makes it a little bit easier. Although, certainly I have a lot of FOMO, but it makes it a little bit easier to sit out some of these crazy rounds because, maybe I shouldn't say crazy, but certainly some of these really large rounds.
Large rounds.
Yeah. So I don't know if that answered your question.
Yeah, I feel your struggle on that side, and then when the market becomes, when you look at it, and the people ask the inevitable question, is it, are we in a boom market, and what can you actually do about that? I part of it is I'm sure you get pressure from your investors that you want to make great deals, but at the same time, if you feel that the market is overcapitalized or that it's too frothy, then can you really sit back and not make investments, or I guess you make them slower? Yeah.
I kind of feel like we're very lucky in that we see a great kind of volume of deal flow, and I owe a lot of that to the investors and the people who have lent their kind of association and brand to our platform. So in that deal flow, we see a lot of what we would look at as great companies, great teams, and great values. And many of them are not the sort of sexy spaces that that I've just described. They're in kind of more fundamental innovation areas that are just not as well understood by kind of the mainstream investors that are investing in some of these companies in the hotter segments. I view my job as pretty clear. My job is to make money for the people who gave me capital, and it's also to be strategically relevant to the people who gave me capital. I mean, that's a big part of why they invested in what we're doing. As it turns out, those two things, neither one of them actually necessitates me investing in segments that are, kind of really, really hot. I just have to know the companies in those segments. And so, in a certain way, it doesn't matter if we invest in companies in those segments or not. I would say the only nagging piece of it is ego. Right. I mean, to be associated with a lending club or a wealth front, is, there's sort of the ego, side of any human who's a VC who, you want to have an association with some of the best companies.
Where do you feel that biggest missed opportunity? Was there a deal that came in front of you that got away?
The one that got away.
Yeah, which one's that?
Oh, so many great companies that got away. I could take you through let's see. I mean, Cabbage, is doing great. We got to look early at Cabbage. On Deck, we got to look at the Series B at On Deck.
Wow.
These were both at Highland. At Personal Capital, we got to look at the Series A, the Series B. Betterment, the Series B and Series C. Sigfig, we were competing for a round at Square. There are a lot.
How is Square looked at now in the venture eye? Are they a guaranteed win? Is it super high risk for them? I mean, the fact that they pushed their IPO kind of puts them in question mark. Are people who invest in Square, are they happy they invested in Square? Are they screaming? Or are they kind of sitting in the corner questioning it now?
It's a really good question and a hard one to answer.
Yeah.
Obviously, there's a lot of different investors in Square, and I think if you're an early investor in Square, Khosla, even Sequoia, I think you'll probably feel pretty good still. I think there's a pretty big disconnect between the public perception of what's going on inside of Square and kind of what's actually happening. But I'm not sure that means that if people are skeptical externally that things are going great internally. I've got the kind of the pleasure of being pretty friendly with a bunch of folks who work there or who were involved early on. And my sense is that as bad as people think it might be going, it's not as bad as that when that's the case. And when as good as people might think it is, when people are excited, it's probably there's a lot more challenges than people know about.
Sure.
So and generally, I think the Square Cash has been a pretty exciting kind of growth kind of product for them in terms of usage, not necessarily in terms of economics, I would imagine. But and then the kind of Square Capital, I think has done quite well. In its kind of short lifespan. But in terms of the core business, it's hard to argue that they are anything beyond today still being a predominantly a next generation ISO and maybe payment processor. They're certainly trying to become a software company any way they can. And
now, Dan, speaking of Square as this sort of software, API to the merchant, it seems like essentially some of the companies that you've invested in are sort of trying to approach that in an individual sense, and I see Square doing it in a collective sense. I think the confusion that comes to a lot of the central Square merchants is some of the things become maybe so tangential to what they're really about that it almost becomes a conflicting message. As I'm sure you know, and in doing a lot of your early investments in some of the retail, you wind up finding that merchants may want a lot of big data, but unless that big data is generated in a very, very concise way, charts and graphs are not good enough. Telling me I sold 17 cupcakes on rainy days more than other days. Most merchants already instinctively know that, and it becomes almost like a toy feature, and it becomes a disincentive. At least I see that from the ground level. Yeah. Do you think that as companies in this space get, maybe one might argue, too large? I mean, in some ways, does that become almost an impediment to really pole vaulting into the highly successful realm?
It's again a very interesting thought line. Line of thought. We all just saw Slack raise some more money because they can. It's the commentary on that is quite interesting. I think to some extent, it's not that Square's only raised money because they can, but I think they've raised more money and grown the team and ambitions and raised money at higher valuations because they could. And so I think any definition, by any traditional definition of an ISO or merchant acquirer, if you had looked at Square's growth in the core of their business, you'd be impressed. It's only when you kind of set them on the backdrop of the valuations at which they've raised, where you start to question whether or not they're a long-term sustainable business.
See, that's a critical point, right? Because with a newly IPO'd PayPal in the marketplace, right?
Right.
And Apple Pay. I mean, one cannot stress how I think meteoric the change was for the entire payment industry when Apple dropped in. I mean, we saw it coming. My team here on Around the Coin, we talked about it for almost a year beforehand. But when it dropped in, it left people stymied and bewildered, and the business model at Square had to change immediately. They immediately had to drop the wallet because it made no sense in an Apple Pay world. And now you have PayPal coming in, who one could argue has a tremendous advantage because of the cash on hand that they have, because they already have, in a sense, a mobile wallet. They have the cash of people in PayPal accounts, et cetera. Do you see that makes it much more complex? Do you see it as an opportunity for smaller companies and maybe a lodestone around a larger company because of that change?
You mean the success of
PayPal IPO,
PayPal.
Apple Pay coming into the market? Yep. I mean, that really twisted everything around.
Look, it definitely is polarizing, right? So everybody immediately had to figure out how either Apple Pay, let's just focus on Apple Pay for a second. I think everybody had to figure out how Apple Pay either was beneficial to them or recognize that they were not going to be able to exist in a world where that was dominant and change their strategy. I think most players, kind of that had a mobile payment related application. If I think about folks like Cover, they basically realized that they had to integrate Apple Pay, and it had to be, they had to make that part of a wonderful experience, and and hope that was enough to actually position them for success. But I think others, if you look at I look at Paydiant and even Loop, and to some extent, I mean, those were good outcomes for both of those companies. Candidly, in some cases, maybe even better than I would have expected. but I think both of those companies probably realized that they weren't going to build $1 billion business in the face of what kind of Apple Pay was going to do to the market, or could do to the market, and much better to take a nice exit now, rather than try to keep kind of trying on your own.
Did you notice a change in your portfolio of companies when it became obvious that Apple was going to be in NFC payments and in-app payments, fingerprint technology, tokenization, the whole infrastructure?
Not as much as you might think, just because if you look at our portfolio, the payments companies we've invested in, Bill.com, which is a B2B payments network,
sure,
and SaaS provider, and BitNet, which is really focused on digital payment acceptance, and then the one that probably it's most relevant for is Marqeta, and I'd say they're relatively agnostic, really, as an issuing processor. So it doesn't hurt them in any way. It doesn't really force them to change much. There is actually some interesting potential upside for them in their strategy, but it's not. But I think it didn't really change a lot of the sort of core payments folks. And then from a experiential kind of retail technology perspective, I think only positive, because I look at we talked a little bit about beacons earlier. I look at
sure,
the importance and relevance of beacons. If the Apple device, mobile device is a sort of a central part of your retail transaction, then I think that only benefits kind of beacon technology, because that's I view that as a very likely complement. And
absolutely.
And just in general, the digital sort of content percentage of the experience, the retail experience, I think increases. So I think it's a positive for all of the companies we've invested in, but probably not quite so
across the board.
Yeah. It's probably just not quite so kind of impactful of the factor.
Yeah.
I would call iBeacon plus NFC pretty much Apple Pay 3.0 and beyond.
Right.
There's no doubt that these two radio technologies are designed to merge. I think the head fake that Apple did by trying to tell the world they were going to bypass NFC and somehow triangulate you via beacon or
right.
Wi-Fi, the science wasn't behind that. You couldn't get that close to knowing where somebody was, even through great triangulation. But
it's exactly what it was, a head fake.
It was a head fake, no doubt. We read through that. But, the thing about beacons is I think it really brings the promise of what the online world brought to commerce into the retail space, but beyond what I think the usual suspects are. I think, some of your portfolio companies are certainly seeing that. Are you experiencing a lot of entrepreneurs that are getting that sense now that Apple Pay's out there, that the next big footstep is going to be within beacons?
I think beacons are where NFC was a year and a half ago.
Wow.
Now I'll explain what I mean by that, but I think that I'll caveat it to say that the concept of beacon, certainly in the current sense, is much newer than NFC. NFC is a 10, 15-year-old kind of technology conceptually. But in terms of where people's mindset were on NFC, a year and a half ago, I think everybody thought NFC was dead. And I heard it so many different times, and candidly, I kind of believed it. Because you looked at the players who were kind of supporting NFC and an NFC based approach, and you just couldn't see how they were going to get any traction at all. It had been tried so many times and failed every single time.
It made me a rebel. I've been tracking NFC and Apple since 2011, and advising companies that NFC was definitely going to be part of the roadmap. And fortunately for a number of very large retailers, listening to that actually made them, Apple initial partners. But it was funny how politicized NFC became, because it became polarized to a involvement with carrier, right? Because nobody wanted the carrier to be the mainstay of payments mobile, and the whole idea of using the secure element and paying the piper of Verizon and AT&T was lack of appealing. But a lot of my tech colleagues and the startup founders and VCs were like, I don't want to get involved in NFC because that's a political support for carriers. And I said, it's a radio technology like USB. Apple will take USB or NFC and make it in their own image. And it's the only way they could do this at retail. There's no other way to do it.
I 100% agree with you. I think the carriers and the unfortunate venture formerly known as SoftCard, I think was a emblematic example of what everybody thinks as kind of the
what was wrong with NFC? What was wrong with
NFC, but also the failed trajectory of NFC. Yeah. And then I think about Google Wallet and host card emulation. Certainly an interesting kind of approach. It's in my view what happened. Even though it sounds as though you saw this this playing out a long time ago. I mean, really, the networks bringing tokenization to life. And candidly, I don't know. From my perspective as an observer, I think, Apple had this waiting in the wings. Oh yeah. And it was unclear when and if they would move forward on it. And then, they saw a window. And the Target breach was a huge part of that.
Well, it wasn't an impetus, but they really were. If you look at my research, I have obviously some friends inside of Apple, but my research was primarily by public patents. And after about 35 patents directly related to retail NFC, a company even of Apple's size doesn't take year after year that much great talent. 375 different employees working on NFC on patents, unless they have a concerted plan at play. And I know Steve, before he left the company, was very, very adamant that payments was one of their major tentpoles, and obviously that came to fruition. He felt NFC was very strong, and I think a lot of the base team that built around NFC felt that way also. The basic thing that I think was the impetus was really not so much the breaches that was starting it. It was the motivation of EMV, which made retailers reconsider their credit card terminals and their POS terminals, and whether or not they were going to have a chip in, obviously a radio in there.
But I mean, not that I disagree. I
Sure.
I actually agree. But but you also have to recall where we were with EMV deployment.
It was
in the US.
terrible.
No, but most people, it was the progression of EMV deployment, kind of mandate was slowing, not accelerating before Target. So what happened was when Target hit, it actually created a the EMV mandate acceleration that created a very fertile environment for
it became a political thing. There was Congress and Senate. Thing. Yeah.
And yeah.
The thing about EMV though, and the thing to on the retailer side, and this is where I've done so much research, is I call it the EMV user interface fail, right? The UX fail. The problem in the United States is after October, standing in line behind people who are trying to use EMV cards is going to be a bit of a I call it a circus act type of scenario, because you have people of all different stages of life. You have senior citizens, you have younger people, and you have devices that have slots that may not be very apparent how they work. The biggest problem with EMV in the United States is there's no demarcation when that card has to be removed. You and I are familiar with the swipe. That is a one-step process. The card swipes through the terminal. You put it back where it belongs. EMV in the United States is not like that. You have to insert the card, and then you have to wait for a moment, whatever that moment is. It could be 30 seconds. It could be 10 seconds to disengage that card from the reader, or the dip, if you will. And the problem with that is if the card's removed too quickly, if it's just swiped, it will not do the transaction. Whereas in Europe and Canada, it's EMV with PIN. You know when to remove that card because you entered your PIN number. In the United States, this fail is actually going to motivate more NFC usage, because people are going to get frustrated and say, when the heck do I remove my card? And even in Canada, 9% of cards are left behind in Canada, even to this day. People put
That's
it in a machine.
insanely high.
It is incredibly high, and these are people who are putting in PIN numbers. So we have interesting times ahead. Now we're going a little long, but I really want to ask, because I look at your company list, how do you feel about the delivery and the on-demand economy that's developing, and how does that fit into to your business plan and your constellation of companies in the future?
Yeah, that's a great question. I think what's difficult to do is parse out the sort of secular shifts from the kind of excitement and perhaps overexcitement of of our industry. And again, I think what happened, there's a tendency to sort of get this irrational exuberance around themes and this sort of fear of missing out that drives people to make investments at increasingly higher prices and shorter periods of time. So Dan,
you're not going to invest in another food delivery company, right? I hope not.
Well, I don't think we're likely to. So right. I think what we decide, and you asked earlier what some of my biggest misses were. I mean,
yeah.
I whether or not we could have actually made the investment. I did speak with Uber at the seed round, and
oh boy,
gosh, do I wish we had invested in that. But I think there are marketplace there are marketplace businesses that are enabling independent workers to find and complete deliveries for other folks, and I think that's kind of an interesting space. I mean, it's sort of what Uber did in the transportation industry, or has done in the transportation industry, and so I think those are interesting fundamental opportunities. But being a logistics company is not trivial. And so, any company that looks more like a logistics business, we're probably not likely to invest in, because at the end of the day, what you're constrained by, and, I think Square sees this from a payment processing perspective, is you're constrained by the exit multiples of the businesses that you compete with. And potentially disrupt, right? At the early scale, at the early sizes, or early scale, and an exit can be, kind of at a disproportionate revenue multiple. But as you get larger, you're really constrained by the sort of rational multiples that your large competitors or existing players get. And you have to ask yourself, are you a technology business or are you something else? So I think there are some interesting businesses being built in the kind of on the delivery space, but I'm just not sure that they're technology businesses. And we're in the business of investing in technology companies.
So Uber today, if Uber showed up today with your current, and obviously not with the history of knowing how well they're doing, with your current way of seeing things, would you see them as because I see them primarily as not a transportation company, but a logistics management company, and they're incredible about managing all sorts of assets and putting them together at the right time. Do you see it that way, and do you see that as core, as part of payments, or do you see it more mechanically if an Uber showed up?
It's 100%. I agree with you that it's first of all, it's a technology business. It's a marketplace. Sure. It's a technology platform that encompasses payments and logistics, and it is a marketplace that's attached to it. The marketplace, is what gives, I think, the business a marketplace revenue multiple,
sure.
Or better. But what enables that is, kind of a very logistically challenging, kind of logistics business that requires, control of operational complexity, and obviously from a payments perspective, that's an integrated component of what they do. So I don't know if that answers your question, but I don't think of them as delivery companies, or transportation company.
Yeah, I see this trend. And I think Square is trying to ride that out. And my personal opinion, I think it's not such a good idea with food delivery. But I just know way too much about that market on a local level that your ability to dominate on a national scale is a fantasy, absolute fantasy. It's not going to be like Uber. It's a completely different model. But I see a lot of ideas like this, all the way to what Mike's doing with Home Hero, all the way down to some of these companies that are doing packaging and things at that level. They are in some very essential stages, really payment companies extending into this marketplace. But I think it's right now, you're not quite seeing it. I think as we look back 5-6 years from now, will say, wow, these were really just manifestations of different forms of payment companies because they really are riding on that.
Yeah, look, in a way I agree with you, but that would be like calling eBay a payments company, and I think we have to recognize that right. It's that particular case, and Alibaba and the same. Like,
well, look what happened to eBay when PayPal leaves, right? It's going to be a different world,
right? It's not so. Is payments core to a marketplace business? Absolutely, and is fraud prevention and is all that stuff core to? Absolutely. However, if I look at companies like WePay and to a certain extent, kind of others like Stripe and kind of in Braintree who are doing stuff in kind of marketplace payments.
Sure.
I mean, you can pull the sort of payments aspect out and provide it to marketplace businesses so that it doesn't have to be core. But back to your point, I mean, what Mike's doing and obviously what Uber's doing, and there's a bunch of labor marketplaces that I think that's the secular trend stuff. That's what's really compelling. And so you have to ask yourself, well, why is that happening? And I think what's happening here is, people lost trust in 2009. They lost trust in the American corporation and the sort of the more traditional legacy employment promise that they had from working hard and having kind of tenure in a large or kind of corporate environment. And so when that trust bond went away, people began to second guess what it meant to be employed and what it meant to be unemployed. And part of this is the millennial generation for sure, but a big part of it is just people's willingness to take their or not even willingness but desire to take their employment levels into their own hand.
I love the way you put that together. Mike, are you seeing that? Because, I mean, you're right at the forefront of it. You're seeing a lot of people recapturing the American dream sort of by taking the reins?
Yeah, it's funny. I think it almost rides in the emotional mentality of people who, because, if you're in your, say, 25 to 35 range right now, your parents grew up in the heyday of the American economy. So you're used to an environment where your dad probably works like 35, 40 hours a week and he makes a great income. You're in the upper middle class and you sort of have a ratio of work input to output in the world. And frankly, that generation, like the baby boomer generation, they benefited from those who went to war and those who worked really hard and those who came out of the Great Depression era. So that era kind of led to the benefactor of the baby boom generation, which led to the generation now who I think really believes that it's better to just chase your dream and not worry about income or a steady job, and kind of the typical jobs that were once appreciated are now being a doctor, being a lawyer, those are kind of like viewed secondarily. And it's more about how do we fulfill and make enough money to chase our dreams, and that make enough money, work flexible. That is the on-demand economy. The on-demand economy in my mind is just to satisfy people chasing after someone else. Like anytime you get in a car or anytime you talk to any one of our caregivers or a Lyft driver or Postmates, anyone, they're all doing something else. So I think it's a fantastic way to subsidize it.
And almost uniformly, when I've talked to kind of Uber drivers across the board, they're the ones I'd probably get exposed to the most. I ask them a very simple question, which is I ask them what they were doing before, and are they making more now, or were they making more before? And almost 100% of them were making more money before than they are now, but they enjoy their life a lot more now because they are able to control when they're working. And so to a certain extent, you have to ask yourself, is the on-demand the consumer, kind of getting the ride, or is the on-demand the provider, kind of who's getting employment on demand? And that's kind of the interesting, kind of piece of it to me.
Yeah. Hey, Dan, I wanted to ask you before we wrap up here, is there anything that, be helpful to kind of send a general message? Are there companies or people or founders or anyone that you would want to get in touch with? And if so, how would someone get in touch with you?
Yeah. So, and then I'm going to have to hop off because right after this. So look, we're excited about working with entrepreneurs who think our network and experience can be, helpful to them. So we're looking for companies that typically have products and have launched and have some early results, because that makes it easier to kind of introduce them to other companies that should want to work with them. But I'd say, we're talking to dozens of companies, kind of every week. So we want to see any interesting innovation that's in our spaces. And unfortunately, we can't invest in every company, but we do our best to be responsive where we can. In terms of shout outs, I mean, I love every one of my portfolios. We have the time to talk about them all, but no, we're, I'd say anybody who wants to get in touch with me, I'm Dan@commercevc.com. Recognize that, we're pretty lean ourselves as a startup firm. So if I don't respond immediately, it's not about not being interested. It's more probably likely that there's just, an overabundance of email and just sorting through it. But I invite anybody who thinks there might be an opportunity as a match for us to reach out.
Awesome. Well, thanks, Dan. We really enjoyed having you on the show.
Really good show.
Insightful, and best of luck.
Thanks so much for having me.
All right.
Thank you.
Take care.
Take care.
Bye-bye.